traders, to today's rapid-fire macro explainer. We're diving straight in, delivering the terminal-level data and actionable technical setups you need for the trading day ahead. Whether you're navigating the FX markets or tracking global equities, we've got the overnight catalysts and the tactical charts you need to form your strategy today. Let's get to it.
8%. Seriously, just 8%. That is the totally crashed probability of a July Fed rate hike following yesterday's data. It seems U.S. inflation finally remembered that gravity exists. Headline CPI fell 0.4%, which is actually its biggest drop since April 2020. But, as former Fed Governor Kevin Warsh rightly pointed out, one good inflation report doesn't win the championship.
And this right here perfectly illustrates the massive tug-of-war markets are facing today. On one hand, cooling U.S. inflation is finally taking the pressure off central banks. But on the other hand, geopolitics are rapidly heating up. U.S. forces launched fresh strikes on Iranian targets near Bandar Abbas, and with a full cargo blockade announced in the Strait of Hormuz, Brent crude is holding stubbornly above $83. So yeah, markets absolutely cannot get too comfortable right now.
All right, Section 1. Today's key data watch.
Central banks are just as busy as we are today. Over in China, we're watching Q2 GDP and industrial production. Europe is delivering its own industrial production numbers as well. For the U.S., literally all eyes are on the PPI print to see if it confirms yesterday's CPI drop. And finally, the Bank of Canada steps up with its policy decision. It's a packed slate, so keep your risk management super tight today.
Moving right along to Section 2, Major Currencies Technical Overview.
The crucial driver for the DXY right now is yields. Following that lower inflation print, which remember came right on the heels of a soft non-farm payrolls report, U.S. Treasury yields retreated. The 10-year finished at 4.59%, initially pulling the rug right out from under the dollar index. But as those geopolitical fears crept back in overnight, that dip was bought up incredibly fast.
So, heading into that critical PPI release, here is your map for the DXY levels today. That dip buying we just talked about occurred right in our support zone, between 100.47 and 100.57. If the dollar catches a bid on safe haven flows, or if we get a hot PPI, resistance sits immediately at 100.89, with a further ceiling up at 101.41.
For Euro USD, our overarching tactical view today is clear. Sell on rise. Let's break down exactly why.
Now, the euro did recover on the soft U.S. CPI, but Eurozone bond yields, they were completely unchanged. Markets are anxiously awaiting to see the true extent of the Middle East energy shock. Plus, sentiment indicators across core Eurozone hubs are showing persistent stagnation. Today's Spanish CPI and Eurozone industrial production are definitely key, but those energy fears are strictly capping the euro's upside.
The levels for this sell-on-rise strategy are clearly defined on the chart. Robust resistances are waiting for you at 1.1447 and 1.1483. Any pop toward those levels offers a solid entry. On the downside, the pair tested support at 1.1388, making it the critical floor to watch for today's session.
Conversely, crossing the channel over to the British pound, the tactical tag here is buy on dips. And honestly, this is a trend that is working really well right now.
Cable bounced aggressively on that lower U.S. CPI. A huge driver here is the UK 10-year yield, which actually drove past the highly psychological 5% level before easing off slightly. Look, yields are in a very uncomfortable zone for the UK, and that's keeping the pound heavily supported on any pullbacks. Also, keep an ear out for today's speech from the Bank of England's Hugh Pill. To execute this buy on dip, we have some really solid support resting at 1.3393 and 1.3345. Up top side, we have a steadfast resistance at 1.3450. Cable tested this level overnight and it held firm. A convincing break above there, that would be a major signal.
Turning to the yen, we are in a pretty tricky trading zone. There's a surprisingly massive fundamental driver to note here. Because of the Middle East conflict, the Bank of Japan has actually forced down their median 2026 GDP projections to a mere 0.5%. That said, underlying consumption engines are still operational. It's a real mixed bag, meaning you need precise technicals.
Because of this fundamental ambiguity, you've got to stick to strict conditional logic for USDJPY, pivoting heavily around 162.71. Step 1. Monitor price action right at 162.71. Step 2. You buy only on a clean break above 162.71, Or step 3, you play the resistance by selling at 162.71 with a very tight stop at 163.00. Discipline is absolutely paramount here.
Section 3. USD INR Technical Breakdown.
The Indian rupee slid to a one-month low of 96.20 intraday. The overarching weight pulling it down? A brutal 20% spike in crude oil and relentless importer buying. India did attract $10 billion through the RBI's special deposit program for overseas Indians, but guys, it's simply not enough to stem the tide of this expensive oil, even with likely RBI intervention.
The crucial trigger is this breakout scenario. The pair closed exactly at the resistance of 96.18, and that's a strong signal because it's above the weekly pivot of 96.05. A sustained break above 96.18 lifts the ceiling entirely, opening up a target of 96.90. If it fails, watch for that 95.82 support.
Finally, Section 4, Nifty Tactical Setup. Indian markets were dragged down by foreign outflows and Middle East tensions, closing lower at 24,052. But under the hood, we saw some real sector rotation. Defensive buying in pharma and metals offered a bit of a cushion, but that was completely overshadowed by major selling pressure in realty and IT heavyweights, like HCL Tech, which plunged a whopping 4%. The technical structure for the Nifty screams for a buy-on-dips approach. However, there is a massive caveat here: geopolitics. As long as the Middle East conflict threatens global oil supplies, domestic equities remain incredibly vulnerable to sudden shocks, no matter how pristine the technicals look.
Assuming you are comfortable navigating those risks, your upside resistance sits at 24,344, but your absolute line in the sand is 23,900. That is your key pivot today. If the Nifty cracks below 23,900, it opens up a significant drop all the way down to support at 23,576. Which brings us to the ultimate question for today's session. With U.S. inflation finally showing meaningful cooling, but global shipping lanes and energy supplies actively under siege, will you trust the domestic technicals, or will Middle East geopolitics overwrite the charts and dictate your next major breakout? It is a complex board out there today, traders. Weigh those macro forces, stick to the levels we've mapped out, and always manage your risk. Thanks for joining this explainer, and we will catch you in the next one.